Morning, everyone, and a very warm welcome to our Autumn Budget 2025 webinar. I'd like to start by apologising that we are running just a couple of minutes late on our start time. We have had a few technical issues. That's the joy of showbiz, right? But hopefully that's all smoothed out for us now. So we have an expert panel here from Kreston Reeves to highlight the key implications, provide insight and guidance, and answer your questions following Wednesday's announcement. So to introduce myself, I'm Jennifer Williamson, one of our partners at Kreston Reeves, and I'll be chairing our session today. And we're thrilled to have so many of you join us, clients, colleagues, and contacts from across our communities. Whether you're a long-standing client or joining us for the first time, thank you for making the time to be here. So this year's budget has been one of the most anticipated in recent memory because after months of speculation, leaks, intense media scrutiny, including the early unintentional release of the OBR's report, the stage was set for Rachel Reeves' second budget to make headlines. And the pre-budget build-up was dominated by questions about whether the government would keep to their manifesto promises and how they would balance the need for economic stability with calls for reform and investment. And at Kreston Reeves, we believe in supporting you far beyond the numbers. Our mission is to help you achieve your ambitions and navigate this change with confidence. And that's why we host these webinars, to provide clarity, practical insight, and a forum for your questions, especially after a budget that's been billed as pivotal for the UK's economic future. So if I can start with some housekeeping. So this session is being recorded, and we'll share that recording with you later today. We'd love this to be interactive, and we're going to be running some live polls throughout the webinar, and we'd really encourage you to share your views. At the end, you will receive a short feedback survey. We'd really appreciate your thoughts to make sure we can help keep improving these events. And finally, please use the question and answer function at any time. Your questions are really at the heart of today's discussion. And we've already had some questions sent in, but please do continue to submit those throughout the session by using that functionality that's shown on screen. And we'll just leave that there for a moment whilst you familiarise yourself with how to raise a question. So, before we dig into the top implications for individuals and businesses from Wednesday, we'd like to hear your initial thoughts on what was announced. So we have our first poll question for you, which you'll see on screen now. How do you feel about the changes in the autumn budget? Very positive, positive, neutral, negative, or very negative? And if you're still deciding, just imagine you're at that Chancellor's press conference. Would you be nodding along or shaking your head? How's it coming through? Yeah, so on the whole, people not very positive about the results that came out from the announcements. Yeah, a strong majority of people not feeling very positive with the changes that were announced. Okay, thank you very much. Thanks for sharing your views and those initial reactions. Let's set the scene for what's changed and how the reality compared to all that pre-budget speculation. So this year's autumn budget arrived as late as possible after months of intense build-up. Many of the headline measures were widely anticipated, but not everything played out exactly as expected. So where did the speculation align with the announcement? The much discussed freeze on income tax band has indeed been extended, now running until 2031. That was widely predicted and is a clear example of fiscal drag. So as wages rise, more people will move into those higher tax brackets. Increases to dividends and saving tax rates were also heavily trailed, and those have now been confirmed. The restriction on salary sacrifice for pension contributions, that was another rumour that proved accurate, though the implementation date of April 2029 does give businesses and employees some time to plan. And the new high value council tax surcharge on properties worth over 2 million wasn't a surprise for many. That shows the government's willingness to look for revenue in new places. And advisors and analysts flagged business rates as a key area for reform, and Wednesday's announcements confirmed that from April next year, business rates bills in England will be updated, meaning that some businesses, especially smaller ones and those on the high street, will see their rates bills go down thanks to new support and lower rates. However, those businesses in areas where property values have risen may see their bills increase, and it's a really mixed picture, so it's worth checking how your own rates might be affected. But there were also areas where speculation didn't quite match reality. So some commentators expected more dramatic changes to capital gains tax or inheritance tax relief following last year's shake-up. But instead, this budget focused on tweaks like the introduction of a transferable 1 million inheritance tax allowance rather than wholesale reform. And there was talk of significant changes to the corporate tax regime, but these didn't materialise. Instead, the government has chosen to encourage business investment through targeted incentives and updated capital allowances rather than altering headline corporation tax rates. And there has been a long time some concern that the headline grabbing 100% relief from capital gains tax rates for disposals to an employee ownership trust would change. And Wednesday's announcement saw that happen with an immediate slash in that relief by 50%. Now, all of these measures are set against a backdrop of the government's stated ambition to rebuild the economy through stability, investment, and reform. And their stated intention is to encourage business confidence and investment while ensuring the tax system raises the revenue needed for public services. But as always, the real impact will depend on how these changes play out in practice and how individuals and businesses respond. And we're going to be unpacking all of these changes in more detail with our expert panel, and we're here to answer the questions on what it means for you. So let's take a look at how some of the media responded to the budget and the headlines from yesterday morning to give a flavour of the wider reaction to the measures that were announced. The FT headline went with Reeves' budget smashes tax records. That signals a focus on the sheer scale of tax increases or changes. It presents the budget as historic in its impact on the UK tax landscape. The Daily Express, the Daily Mail and the Sun frame the budget as favouring welfare recipients whilst targeting the working, with their headlines: a budget for Benefit Street paid for by working people, spiteful raids on strivers to lavish billions on Benefit Street, and the Benefit Street budget. A budget with a Labour heart from the Daily Mirror presents the budget as compassionate and true to Labour values, whereas the Daily Telegraph went with a red box of broken promises, critically implying the budget fails to deliver on Labour's pre-election pledges. The Guardian highlights a message of shared responsibility, quoting the Chancellor directly: "I am asking everyone to make a contribution." And the Daily Star couldn't resist a tenuous reference to the Grinch with how the Rach stole Christmas, suggesting the budget takes away from the public, especially at a time of year when people are feeling the pinch. So now it's time for me to introduce our panel of experts who's going to be delving into those announcements in more detail. So we have Daniel Grange, Partner and Head of Tax, Sam Jones, Partner and Head of Corporate Tax, and Terry Burgum, Kreston Reeves, Financial Services Chartered Financial Planner. So, were there any rabbits out of the hat from Wednesday or important fiscal details that were glossed over in the Chancellor's speech? Well, first, I'd like to hand you over to Daniel Grange, who's going to be summarising the top implications for individuals.
Thank you, Jennifer, and good morning, everybody. As Jennifer said, I'm going to talk through the key implications for individuals from Wednesday's budget, which include an increase to income tax rates on dividend savings and property income, and the impact that has on extracting profits tax efficiently from companies. I'll also cover the changes to salary sacrifice rules for pension contributions and the slight relaxation to the inheritance tax changes that were announced last October that are due to come into force from April 2026. Then I'll cover a few of the other smaller changes and some things that, whilst heavily trailed in the press, and clients were worried about before the budget that didn't actually change. As is often the case with budgets, changes were announced that will come into effect over the next few years. So I'll try and make it clear when these changes will affect you and remind you of some of the key changes that were announced last year and that have not yet come into force, but there are still some tax planning opportunities available to you. So the first change I want to highlight is an increase in the rate of tax charged on dividends, savings and rental income. The Chancellor in her speech said that the difference in tax treatment between earned income, which is subject to national insurance, and unearned income, which is not subject to national insurance, doesn't make sense. But instead of adding national insurance to all sources of income, she will instead increase the rate of income tax that's charged on unearned income sources. So that's dividends from companies, interest on savings, and rental profits. And these changes are being introduced over the next 2 tax years. From April 2026, so next year, the rate of tax on dividends that fall within the basic and higher rate tax bands will increase by 2 percentage points. So increasing the rates to 10.75% and 35.75% respectively, as you can see on the slide. Interestingly, the additional rate of tax on dividends is remaining unchanged at 39.35%. The basic or ordinary rate of tax is payable on income of up to approximately £50,000, and then the very top rate of tax starts at income of just over £125,000. The Chancellor announced that these thresholds are being frozen until 2031, so more people will become subject to tax and at higher rates as a result of fiscal drag. A year later, so April 2027, the rate of tax on savings and property income will increase by 2 percentage points, increasing the rates to 22%, 42% and 47%. In this case, the increase on savings and property income will apply to additional rate taxpayers. It's just that dividend tax rate that's not changing for additional rate payers. The rate of tax relief on interest costs associated with the letting of residential property will also increase to 22% in line with that rate change. As a reminder, basic rate taxpayers have a tax-free savings allowance, so that's offset against interest income of £1,000, and higher rate taxpayers have 500. Additional rate taxpayers don't get a tax-free savings allowance. And in some circumstances, depending on level and types of income, there's also a 0% starting rate band of up to £5,000 that can eliminate tax on savings income. So I think the important thing to think about here is, with the future increase in the rate of tax on unearned income and the potential allowances available, if you're married, it will be important to think about the ownership and holding of these income generating assets to minimise the income tax exposure. The benefits of ISAs, which allow income and capital gains to be realised tax-free, should also be remembered, albeit that the cash ISA limit is reducing to £12,000 from the current £20,000 from April 2027 for those people who are under 65. A question we often get asked, especially when there's a change in tax rates, is what's the most tax efficient way to extract funds from a company? The answer to this really depends on personal circumstances and the company's circumstances, but I thought it'd be quite helpful to give you an example. So this example shows the position if a company has surplus profit of £50,000 that it wants to distribute to a single shareholder director. And this compares the effective rate of tax of paying dividends compared to a bonus in both the current 2025-26 and next tax year, so 2026-27, after the increase in the rate of tax on dividends. Dividends are not a tax deductible cost for the company, but are subject to a lower rate of tax for the individual, whilst a bonus is subject to higher personal tax and employers' national insurance, but the company does get tax relief. As it says at the bottom of the slide, this is indicative only and is based on a number of assumptions. and this should not be taken as giving the best course of action in all circumstances. But as you can see, based on this scenario, it's marginally more tax efficient to pay bonuses rather than dividends in the current tax year, and the benefit increases next tax year after the increase in the dividend tax rate. But that won't always be the case. For example, if the company is paying tax at 19% instead of 25%, or the extra income would push the individual's total income over £100,000, so they might lose their tax-free allowance, dividends might be a more tax-efficient route to follow. And there's also a cash flow advantage of paying the tax on dividends via self-assessment compared to paying PAYE on the bonus immediately. So, as is often the case with tax, your personal circumstances will determine which is the most tax-efficient route for you to extract funds from a company. In line with many budget predictions, the Chancellor announced a cap on national insurance relief on salary sacrifice for pension contributions. A salary sacrifice is where an individual sacrifices some of their salary for an employer-provided benefit, normally one that is more tax efficient. So from April 2029, so this isn't for 3.5 years or so, there will be a cap of £2,000 on salary sacrifice for pension contributions that benefit from national insurance relief. It's really important to note there's no change to the income tax position on salary sacrifice for pension contributions, meaning that full tax relief is received. The impact of this will be felt by individuals and employers who are either higher earners or those making large pension contributions. The table on the slide shows the cost of the individual and the employee at different salary levels if the employee is sacrificing 5% of their salary. As you can see, for an individual earning £40,000 a year and sacrificing 5% of their salary into pension, there will be no cost. But an individual earning £100,000 and sacrificing 5% of their salary will cost them £60, and the cost of their employer will be £450 before they receive tax relief. So whilst that's frustrating for individuals, the true cost of this change will be to employers, especially those with large workforces where the impact could be significant and will need to be included in future budgeting. Many employers share this national insurance saving with their employees, and this will need to be factored into any adjustment when the time comes. The biggest change in last year's budget from a personal tax perspective was the change announced to inheritance tax. Currently, assets that qualify for business property relief or agricultural property relief can benefit from unlimited 100% relief from inheritance tax. But from April next year, relief is going to be restricted. There will be a £1 million allowance per person that qualifies for 100% relief, and any value over £1 million will benefit from a 50% relief, giving an effective rate of tax of 20% on death. I'm sure you will have seen lots of press coverage about the family farm tax, and farmers and landowners will be affected, but it's not limited to just farmers and landowners. Anyone who owns a trading business worth more than £1 million will be affected by these changes. So if you're a business owner, farmer or landowner and you've not reviewed your inheritance tax position since these changes were announced last year, I would encourage you to do so urgently. A window of opportunity to act under the current rules will close on the 5th of April next year. I don't have time to cover these opportunities now, but you can view our previous IHT planning webinars on our website, or you can ask questions via the chat and we will try and cover them later. I've mentioned the £1 million allowance, which is per person. When these changes were originally announced, the £1 million was not going to be transferable between spouses on death. And this was different from the other inheritance tax allowances, such as the nil rate band and the residence nil rate band. We, together with other tax advisors, professional bodies and industry representatives, explained to government that this was unfair and would require complex will drafting to secure the relief. And we were pleased to report that in the budget on Wednesday, the Chancellor announced that that £1 million allowance will now be transferable between spouses on death. And this could save married couples £200,000 in inheritance tax without the need for complex will drafting. If you do own business assets, we would recommend you review your will to ensure it's up to date, reflects your current wishes, and is tax efficient. So I've covered the three big changes that were announced on Wednesday, but what else has changed? As Jennifer mentioned, there's a new high-value council tax surcharge, or so-called mansion tax, being introduced from April 2028. This will be collected alongside council tax and will range from £2,500 a year for properties worth more than 2 million, up to £7,500 for properties worth more than 5 million. We're also expecting a new charge for drivers of electric and plug-in hybrid vehicles based on the number of miles travelled in a year. And this change is being consulted upon, but the suggestion is a charge of 3p per mile for electric cars and 1.5p per mile for plug-in hybrids. So these are the things that have changed, but what hasn't? There was a huge amount of speculation, and as I said earlier, clients were really concerned about potential further changes to capital gains tax, inheritance tax, and the perennial budget prediction around pensions. So despite all the speculation, there were no changes to capital gains tax rates, and these remain as previously announced. But do remember the rate of tax on gains qualifying for business asset disposal relief is increasing from 14% to 18% from the 6th of April next year. I'm sure most of you are aware, but if you give away an asset and live for 7 years, the value is outside of your estate for inheritance tax purposes, and there's no limit on what you can give away under this rule. There was some speculation the 7-year rule could increase, for example, to 10 years, or that a cap on the amount that could be gifted would be introduced, but nothing was changed on either of these fronts. Sadly, apart from the £1 million allowance being transferable, there was no relaxation of the new APR and BPR rules that will come into force next April. And finally, although there's always lots of speculation about pensions, apart from the change to the salary sacrifice rules, there were no changes to tax relief on pension contributions or the tax-free cash. Do remember that whilst pensions are currently exempt from inheritance tax, from April 2027, this will not be the case, and the value will form part of your estate for inheritance tax purposes. And there was no relaxation to this previous announcement in Wednesday's budget. So that's it from me on the personal tax implications. I'll now hand back to Jennifer.
Thanks very much, Daniel. So perhaps not that surprising that we had quite a negative reaction to the budget, given the higher tax on dividends, savings, and property income, plus that continued freeze on income tax bands. Obviously, that's going to see many people with their tax bills rise. So if Daniel's presentation has raised any questions you'd like answered, please do remember to use the question function, and we will pick up as many of these as possible in the panel discussion part of the webinar. So we're going to move on to share our second poll. My apologies, I do now realise that some of you weren't able to see the first poll that came up. Just a technical glitch there. Hopefully the second one will work better for you. So our question is, what's your top financial priority following the budget? Is it managing those higher tax rates on dividends and interest? Perhaps tax planning for rental or second properties? Maybe maximising your ISA and saving opportunities, or planning ahead for inheritance tax, or maybe all of the above? Oh, quite a mixed bag coming through. It's always interesting. Some of the changes that sound small on paper end up making the biggest difference. Yeah, there's quite a balance. Other than the second or rental properties, there's quite a balance between the rest about dividends and interest, ISAs, inheritance tax, and everything. So lots of things for people to think about for sure. Lots of time to reflect on your own position and see how you can maximise your take home and reduce the tax obligation. So next, to summarise the top implications for businesses, I'm going to pass you over to Sam Jones.
Thank you, Jen. Good morning, everyone. So I'm Sam. I'm a partner and head of corporate tax. I'm going to be taking you through the top implications for business from this week's budget. The government is resetting its strategy to back entrepreneurs and make the UK the best place to start, scale and stay. There's a renewed emphasis on ambition, innovation and growth, with targeted actions to support businesses at every stage. So today, the key areas we're going to cover are support for scale-ups, which covers the enhanced tax release for investors via the Enterprise Investment Scheme, or EIS, and changes to the Enterprise Management Incentives, or EMI, which help businesses retain top talent by offering share options. We will touch on the capital allowances changes and provide a reminder of the various capital allowances available for businesses. The headline grabbing 0% tax rate on sale of your company to an EOT has been abolished and replaced with a 50% exemption from CGT. There were rumours of changes to corporation tax, however there weren't any, and the CT rates remain at a small profits rate of 19% and a main rate of 25%. The government has committed to capping the main rate of CT at 25% throughout the duration of Parliament. We're also going to touch on some of the other changes which might be of interest. So let's get started. The first area I want to look at is the support for scale-ups. The budget increased the thresholds to 2 tax advantage schemes, being EMI and EIS. These reliefs are a valuable tax relief for growing businesses. So what is EMI? EMI is a government tax approved share option scheme designed to help smaller, high growth companies attract and retain employees by offering tax advantage share options. The key benefits are employees can receive share options with significant tax advantages, being no income tax or national insurance on grant or exercise if certain conditions are met. Gains are subject to capital gains tax, which will often qualify for BADR as long as the options or shares were held for at least 2 years. The increased company thresholds and a longer exercise period were announced at this week's budget. This means more companies can continue to use the EMI as they expand rather than outgrowing the scheme prematurely. Share options are a great way to align the company and employee goals. If you think about a bonus, it rewards past performance and may not help you retain your talent, but options, when modelled correctly, can achieve this. So what is EIS? EIS is a scheme that encourages investment in early stage and high growth companies by offering generous tax relief to investors who buy new shares. Investors can claim 30% income tax relief on the value of their investment, subject to certain limits. There's no capital gains tax on disposal of EIS shares as long as they've been held for at least 3 years. Capital gains tax from other disposals can be deferred if the gain is reinvested in EIS shares. There's even loss relief available if the investment doesn't work out. The limits for EIS investment have doubled, more on that later, allowing more companies to continue to qualify for EIS support. If you are seeking to raise funds for growth, EIS makes your business more attractive to investors, and the new limits will now enable larger funding rounds. Next, we'll look at the changes to the 2 reliefs. Can I go back 1 slide, please? Thank you. From April 2026, the EMI eligibility limits will be extended. So the company option cap doubles to 6 million. This is the total value of shares as at the date of grant, which can be under EMI at any given time. The gross asset limit increases to 120 million. This is as at the date of grant. So that's the balance sheet as at the date you're issuing all your options. And the maximum number of employees you can have at the time of grant is 500 employees. The exercise period has been extended to 15 years. Currently, your options have to be capable of being exercised within 10 years. That's extended to 15 years. And if you've already got an existing scheme, there's no need to amend your rules. The Important point to note here is the individual employee cap has remained at 250,000, which can be prohibitive to larger companies. However, we often model an EMI scheme with the use of growth shares to reduce the value of the shares under the option. Also, EMI options will be for minority holdings, and there are significant minority discounts available to reduce the valuation of the shares. If you're thinking about an EMI option schemes, please do reach out. So let's take a look at the EIS changes. Again, from April 2026, the EIS thresholds have been extended. The annual investment limit has doubled to 10 million and 20 million for a knowledge-intensive company. This is the amount you could raise per year via EIS. A knowledge-intensive company is generally what an R&D company or an innovative company, and it looks at the amount of sort of technical individuals you have within your company. The lifetime investment limit has also doubled to 24 million and 40 million for a knowledge-intensive company. This is the maximum you can raise via EIS over the company lifetime. The gross asset limit rises to 30 million. This is the balance sheet gross asset size before you issue shares under EIS, and there is also a post-investment limit, which is 35 million. I can confirm there's no changes to the EIS investor tax reliefs, but VCT investors' income tax relief will drop from 30 to 20%. This is a valuable relief to attract investment and great tax incentives for UK investors to invest in early stage high-risk companies. Capital allowances remain a vital relief for capital expenditure. Here's a summary of the main allowances. The £1 million annual investment allowance. This has been around for a while and has been a permanent relief now. It's shared between group companies and companies under common control. However, it's not available for all businesses, such as partnerships with a corporate member, and it can't be used for leasing assets. There are two reliefs that are only available to companies, being full expensing, which allows 100% relief for most new and unused plant and machinery, but it excludes cars. There's also a 50% first year allowance for special rate expenditure, which covers integral features and long life assets. The budget announced a new 40% first year allowance for new and unused plant and machinery, again, not cars. This is available for all businesses and it's actually available for leasing as well. And this applies for new expenditure from 1st of January 2026. The main pool writing down allowance was reduced as part of the budget to 14%. It's been 18% since 2012, and this change comes into effect from April 2026. I would say though, most businesses are able to take advantage of 100% relief on capital expenditure via the AIA or the full expensing and only have small pools incurring the writing down allowance, so this reduction should not impact too many. There's been no change to the special rate pool writing down allowance at 60%, and the 100% relief for electric vehicles has been extended to 2027. And there's also a structures and buildings allowance available at 3% per annum for buildings that you're using within your business. So there is going to be a little bit of planning for the timing of your capital expenditure to make sure you maximise the upfront relief, especially with the new 40% first year allowance and the extended EV incentives. The Chancellor removed the headline grabbing 0% capital gains tax rate for disposals to an EOT. Instead of restricting relief to only 50%, the change is effective immediately and will affect anyone making a disposal of company shares to an EOT. So what is an EOT? An EOT is a trust, typically a newly incorporated company, which will hold the shares for the benefit of the company's employees. It's a bit like a co-op. This will allow the company's employees to have a stake in the business, sharing profits and proceeds on an exit. In return, the shareholder selling their shares to the EOT used to enjoy a reduced 0% rate of CGT. Due to the advantageous tax rate, there are a number of qualifying conditions to satisfy to prevent abuse of the relief, such as outgoing shareholders and their family being unable to participate in the EOT. So what's changed? The change to EOT tax relief is significant. CGT relief on qualifying disposals is cut from 100% to 50%, which results in an effective CGT rate of 12%. The gain on the disposal is held over into the EOT. So does this mean we will see more secondary or onward sales of EOTs? Business asset disposal relief is not available as well as the 50% relief. That would be too good to be true. And all of these changes are effective immediately. So why have they done this? The cost of the 0% CGT rate was projected to reach 2 billion by 2028-29. So the government is balancing the cost and preventing abuse. There is still an opportunity here though. The EOT remains attractive, but the window for the 100% relief is closed. If you're considering employee ownership, review your plans now. So I'm going to touch on a few other notable changes that were announced in the budget. These included corporation tax penalties will be doubled where you have a filing date on or after the 1st of April 2026. So a late CT return will now incur a £200 penalty, increasing to £400 where the return is more than 3 months late. The aim is to encourage companies to file on time. With the 2% increase to dividends tax, this is fed through to the Section 455 charge, which will also increase to 35.75 from April 2026. The Section 455 charge is a punitive charge where loans to participators remain outstanding more than 9 months after the year end. The corporate interest restriction, there's new rules for appointing reporting companies. It's an ease to the admin requirements and removes the time limit to appoint a reporting company, which will now need to be reported in the CIR return. There's a brand new listing relief that was announced, and this provides a 3-year exemption from the 0.5% stamp duty reserve tax when a company is newly listed on a UK regulated market, being the FTSE or AIM. This applies from budget day. Incorporation relief, it's been around for a while and it used to be an automatic relief. This now needs to be actively claimed in your tax return. And R&D, there were no changes to the schemes, which is a welcome relief. We've all seen so much change over the last few years. But the government will pilot a targeted advance assurance service from spring 2026. This will enable small and medium-sized enterprises to gain clarity on key aspects of their R&D claim before submission to HMRC. To summarise, the budget brings both challenges and opportunities for business. The key is to act early, review your current arrangements and consider how the changes affect your business and seek advice where required. That's all from me. I'm going to hand back to Jen.
Thanks very much, Sam. And I'd like to thank our audience for bearing with us during the technical issues we faced during Sam's presentation. Unfortunately, there have been just some minor issues with our hosting platform. But it seems from Sam's presentation that perhaps there are more incentives for businesses than we've seen for individuals. And it's good news there's no increase to that main corporation tax rate. So the question functionality is just back on screen now. Please do continue to submit your questions. We're nearly there and ready to move on to those and answer what you have for us. But before we get there, our third and final poll, which you should see on screen now. So for those business owners amongst the audience, in light of the changes, what is your main priority for your business over the next 3 to 6 months? Is it growing your business, sustaining your business? Is it business survival, selling or exiting, or something else? It's really interesting to see where businesses will be focusing their priorities in light of the budget. Okay, so most appear to be focusing on growing your business, and then the follow-up is sustaining. So yeah, still lots of appetite for people to invest, and hopefully some of those measures will help with that. Okay, so it'll be a blessed relief that we are now moving away from slides, given our issues. So I'd like to welcome all of our experts onto the screen. And we're going to move on to our questions. So they've been coming in, but please do continue to submit these. and I submit them as we showed earlier on the screen. So let's have a look at what we had come in. So Dan, I've got the first question to ask for you. Christopher has asked, how does the fact that the 1 million BPR allowance is now transferable affect the way I should be planning for inheritance tax?
That's a really good question, Christopher. I think the first thing I'd say is anybody who's got business assets, business or agricultural assets, should be understanding what the rules will be from next April and understanding the impact on them and how significant that is. The fact that the £1 million is now transferable, the £1 million allowance is now transferable, means that we don't necessarily need to be thinking about transferring assets between spouses to secure the relief, or putting quite complicated trust structures in people's wills. So I think it's a simplification, which is really good to see. It means that we don't need to be moving assets around and dealing with wills as much. But I think a general review, understanding what the impact is, and thinking about whether there's any planning that's needed before the 6th of April next year is probably the next step.
Thanks very much, Dan. Sam, I'm going to move over to you for the next question. We've had one in from Carol, who's asked, does the 50% relief mean EOTs are no longer providing any tax benefit?
I don't think that's technically true, because the effective 12% tax rate is still significantly less than the 18% you get for BADR, so the old entrepreneurs relief, or the full CGT rate of 24%. So it's still a 50% reduction in the full CGT rate. And also, I think EOTs are still useful where you do want to encourage employee ownership, so it's still a good succession plan. Those sorts of businesses are really able to grow and sort of leapfrog into their next stage. And actually, we're seeing now the second round of EOTs perhaps, so they're getting some external investment in to potentially free up some capital that the EOT's holding and allowing them to grow for the next stage.
Great, thanks very much, Sam. So 12% really does still reflect a really low capital gains tax rate, so still worth thinking about. So Terry, I've got one for you now. We've had Lindsay asked, how can I structure my investments to be as tax efficient as possible following the budget?
Thank you for that. I think it's important to remember that there hasn't really been that much changes to the tax structures that are available. So we've seen a reduction in the cash ISA allowance, of course, but stocks and shares ISAs, you can still put £20,000 in those and they remain free of capital gains and income tax. Again, as Dan mentioned, there's been no real change to pensions. Other than salary sacrifice, but you still get full tax relief at your highest marginal rate, and the annual allowances haven't been reduced. And again, pensions grow free of capital gains tax and income tax, and there's no change to the tax-free lump sum allowance either, which is again good news. So capital gains tax remains unchanged, so you may wish to sort of focus more on growth investments and maybe income producing investments going forward. And of course, we've still got other tax structures which are perhaps less used, like onshore and offshore bonds, which can defer tax to a later date, which can be very useful if your tax position is going to change in future years, such as in retirement, or if you think that tax rates will come down again, maybe at a future budget. So still plenty of options to look at.
Thanks very much, Terry. That's great. Sam, I'm going to move over to you next. We've had a question in from Mark. He's asked, there are so many types of capital allowances, it's confusing. Is there a preference as to which reliefs we should use in priority?
Yeah, I think when we're looking at people's tax returns and their sort of capital allowances pools and their spend, we tend to try and use the annual investment allowance in priority, just because there's no sort of clawbacks or anything else there, and it's quite easy just to claim. And also we tend to use the AIA against the special rate pool first, because they get the lowest amount of relief, because it's only a 6% writing down allowance after that. After that, we tend to look at the full expensing and the 50% first year allowance that's available for companies. And if you're not within the company regime and you're unincorporated, you'd now be looking at that 40% first year allowance that's available. And then it's just the remaining balances after that with the allowances that are there.
I think broadly the answer is if you've got significant investment to make, it's just worth checking in the order of priority in which you are using those various allowances to maximise the relief.
And I was just going to jump in there and say as well, it's the timing of your expenditure. So quite often the questions we get around companies' year ends or people's tax year ends is, I'm planning to invest in a large item of machinery for their business, and at what date are the allowances available? So it's, if you've got a long-term contract, it's just checking the timing of that and then what year the expenditure will fall in.
Yeah, great. Thank you, Sam. Dan, one for you now. We have a question from Jessica who's asked, given the rise in dividends tax, should I change the timings of dividend payments now to avoid the higher rates coming in 2026? So I guess Jessica's asking about whether she should accelerate her dividend extraction.
Yeah, I think that's a really good question. If by taking an extra dividend you're going to stay in the same tax band, then that makes good sense, because you'll effectively save 2% income tax by accelerating the dividends into an earlier tax year. But if you're by taking an extra dividend, it's going to push you into a higher tax band, then, but that wouldn't be the case if you spread the dividends more evenly. Then that wouldn't be a good a good thing to do. So we need to think about tax thresholds around £50,000. We've got the high income child benefit charge threshold as well, £100,000 to start losing personal allowance, and then the very top rate of tax kicking in at about 125,000. So in principle, yes, but you need to be really careful if you're at or around those different levels of income. That could mean you actually pay more tax by accelerating the dividends. The other thing to think about is the impact on when the tax will be paid, and particularly payments on account that you have to pay based on the last year's level of tax, an amount on account for next year. So there's some careful payment on account planning needed if you're going to be paying quite different levels of dividends in different tax years.
Great, thanks very much, Dan. So think about your tax rates, think about the timing of payments before you make those decisions.
Absolutely.
Thank you. Terry, if I can pass one to you now. We've had a question in from Liam who's asked, how much will the change to salary sacrifice on pension contributions cost me?
Well, I think Dan had a very good table on his presentation, which showed obviously the changes for people with various salaries. I think from memory, if you was earning £100,000 and paying 5% contribution, it's going to cost you around about £60 a year in additional national insurance. But obviously it's a bigger cost to employers at £450 a year noted here. I think it's quite interesting to remember that a lot of employers might already pass those savings on in national insurance contributions into the pension. So if employers obviously decide to stop that so that to cover their sort of cost, it might mean that you also lose that additional 15% that you get on top of your own contribution. So I think it's obviously got to check what your scheme does and what it gives you to really understand how much you're losing. So yeah, it all depends. And I think for sort of businesses as well on that front, I think there's going to be additional costs, not only in the national insurance, but of course they may have to sort of start thinking of changing the schemes and maybe writing new contracts for employees, etc. So there's going to be sort of hidden costs there as well.
Yeah, because employers, correct me if I'm wrong, Terry, aren't obligated to share the national insurance saving they achieve at the moment. So it's unclear. People would need to check, wouldn't they, whether they're getting that currently or not.
Yeah, so employers who maybe are worried about this change may, of course, if they're already look at their scheme, if they're already paying that 15% to the pension, that might be something that they can change to reduce the impact on them.
Okay, thanks very much, Terry. Dan, another one for you now. Stephen has asked, does the budget make it more attractive to hold property inside a company rather than personally?
There are loads of tax factors to think about whether to hold a property personally or in a company. If we think purely about the rate of tax on the rental income, then yes, potentially it does, because if you're an additional rate taxpayer, you'll now be paying 47% tax on rental income, whereas a company will be paying at 19 or 25%. So that sounds really attractive. but we need to think about not just the tax on the rental profits, but how do you extract that and what happens when the property's sold. So when a property's sold, the company would pay tax on any gain it makes. And then if you want to take the money out personally, you'd have to pay tax again. So there'll be a double layer of tax. And there are different things to think about in terms of perhaps annual tax on envelope dwelling reporting and different stamp duty rules that apply to a company. So as is always the case with tax, it depends, but from a pure headline perspective on rental income, if you're going to keep it in the company and reinvest it for the long term, then a company could be a sensible way to hold property. Just another point there is that individuals have a restriction on the amount of tax relief they can get on borrowings on residential properties, but companies don't have a similar restriction. So that's another factor to take into account.
And I think, Dan, since those interest restrictions rules are introduced, this has been a very hot topic, hasn't it, for lots of property investors. So it's definitely worth checking your own personal circumstances and seeing if a corporate could be the best vehicle for your investments or not.
Absolutely. Can I just add there? I think if people are thinking of buying a new property, that's a really good time to think about the right structure. If you've got an existing rental property or portfolio, the costs or the extra costs of transferring into the company in terms of stamp duty and potential capital gains tax can make that prohibitive. But a new property purchase is really the best time to be thinking about which is the best structure to use.
Yeah, thanks very much, Dan. Sam, I've got one for you now. Hannah has asked, can you provide examples of how companies use the EMI and EIS schemes in a typical client scenario that we might see?
Yeah, of course. So quite often we see EMI being used as a way to retain and align the company's and employees' goals. Quite often a growing business might not be able to pay market rate salaries, and the options are a nice incentive for the employee to make them feel like they've got the share ownership, especially when potentially they're looking for an exit. So an EMI could be an exit only scheme, so they can be issued options today, and as long as there's an exit in the next, well, now 15 years under the limits, but quite often it's a shorter time frame, it encourages that employee to stay with the business, because quite often a lot of the valuable knowledge and goodwill is held within the employee. But at the same time, as businesses are growing, they're going to need more money and more cash in order to do the plans that they want to achieve, whether that's acquiring a new business perhaps, or even just developing their R&D product, for example. They just need the money. So EIS is a great way to attract investors that aren't necessarily corporate investors, they're individuals, and they can invest obviously up to £5 million, well, it's more than that now, £10 million per year, and allow them to sort of grow their business that way. The EIS has no real tax advantage for the company, but it's a huge advantage for the investor, because they get that 30% tax break up front, and as long as they've held those shares for 3 years, there's the exemption on the way out. So it's quite a nice way of being able to sort of promote your business and encourage investment.
Right. I feel like Dan's got something to add.
I was just going to add that those shares, because they've got to be shares in an unquoted trading company, will qualify for business property relief. So there's an inheritance tax benefit for the investor, as well as the income and capital gains tax benefits that Sam's talked about.
Mm-hmm. Thanks very much, both. I hope that helped answer your question, Hannah. Terry, I've got one to pass over to you now. With inflation forecast to remain well above the Banking for England's target, reduced cash ISA allowances and higher income tax, what can I do to improve the return on my cash savings?
Yeah, that's a very good question. So yes, we obviously had many years of interest rates being extremely low. Last couple of years, cash savings have offered a much better return, but they still basically, with inflation at sort of 3.8% and less likely to reduce quickly, we're still seeing clients, especially taxpayers, basically getting sub-inflation returns, which means that they're losing out in real terms on their money. Stock markets over the last 10 years have shown, average returns of growth income of over 9% a year. So clearly there is an opportunity if you're willing to take some risk with your capital to invest your money and get a much better return for it. And we still got, as we say, stocks and shares, ISAs and pensions and lots of tax wrappers we can use to make that as tax efficient as possible. So my advice would be going to, take some financial advice because your capital is at risk, but looking at investing your cash if you don't need it in the short term.
Thank you very much.
Can I just
Dan?
jump in there, Jen?
Yeah, of course.
I was going to say, depending on the amount that you've got to invest, you could also be thinking about using a company structure to invest, and then those are either personal or family investment companies, and those can offer long-term tax advantages as well because of the different tax regimes that apply to a company compared to an individual. So I think coupled with Terry's point about where do you invest, thinking about the structure you use is also important.
Great, thank you very much. Well, we've run out of time to answer questions, but I'd just like to thank everyone who submitted a question and to our panelists for your very insightful answers. As I say, we've run out of time for further questions today, but the volume and quality of questions we receive really reflects just how much interest and perhaps concern there's been around this year's budget. Judging by the number we received, I think we could have kept going until the next budget. But if your question wasn't answered live, please rest assured that one of our experts will follow up with you after the webinar. And if there's anything else you'd like to discuss, please just leave a pop-up note in the survey that we will be sending to you. So this year's budget has sent a clear message. We're entering a period of higher taxes and higher government spending, with the aim of investing more in public services and supporting those most in need. So whether those measures are going to deliver the improvements we all hope for remains to be seen, but what's certain is the landscape is changing, and it's more important than ever to stay informed and plan ahead. Please do take a moment to complete our short feedback at the end of this webinar. Your input really does help us to shape and improve these webinars and events for you. Would just add, we'd hoped to get the recording out to you today, but with our minor technical glitches, that might be next week now, but do look out for it. And finally, whether you're already a client or just joining us for the first time, if today's discussion has raised any questions, please don't hesitate to get in touch. We're very much here to help you navigate these changes and help make the best decisions. So finally, thank you again for joining us today, and enjoy the rest of your day.